For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. This is Managing Your Financial Future, as a nice announcer just said. And thank you. Thank you for that intro. Podcast host, Johnny Dean, that's me. And who's this guy with me?
My name is Rick, the professor, they call me.
Rick,
Plum.
the Professor Plum.
Yeah, that's me.
Yeah. Boy, I tell you what, you're going to be a popular guy. You've already been on a couple of outside podcasts. I mean, we're really throwing you out.
Throwing me out, yeah. Thank you.
We're tossing you out there, you know? But I got you back in familiar territory here, so I appreciate you taking the time to do this particular podcast. I was looking at stuff we've talked about. I think I went back 2 or 3 years just to see different topics and, you know, what we've covered. And this particular topic did not come up.
Okay.
The one we're going to be talking about today. It didn't come up anywhere, and I was really surprised. The topic is value averaging. Now,
I know why it didn't come up.
Why?
Because we were down a lot for the last couple of years, a couple of years ago, and nobody wanted to talk about value average because there was no value to average.
Well, that's true, although we
should have been talking about it in 2021.
Yeah, and I didn't see any. I went to podcasts going all the way back to 2020.
Okay.
And I didn't see anything. Now, I'm sure we talked about it, but it wasn't the main focus. And I want to make it the main focus of this particular podcast because it's a concept, it's a strategy, really, that's not known to a lot of people. And they it's a way, the way I see value averaging, and you can correct me, and we'll explain what it is that it's a check on human behavior, investor behavior. Investor behavior is, to me,
detrimental.
Very much so. It's going up. Got to buy more. Oh, it's getting more expensive. Got to buy more. It's going down. Got to sell. Got to sell.
Well, if you look at the inflows buying into the market in 2021, especially late 2021, it was quite high. And if you look at the inflows into the market in late 2022,
after it had come down,
or the outflows of the market in late 2022, when the market had gone into its little tailspin down 18-20%, money was flowing out of the market, not into the market, which is the exact opposite of what should have been happening for a rational strategic investment plan.
They were buying
buy high, sell low.
Selling low, which
that's problematic.
First day of investing school, they give you the old buy low, sell high.
Right.
You're doing it incorrectly.
Right. And our emotions run wild. We are fearful. Well, first off, in 2020 was actually a positive year for the market, not for a lot of other things.
Well, it had we had a bull market ended. We had that big downturn for about 2 months.
Yeah, maybe.
And then it came back. Yes. Yeah, it was.
But for January to December, It was a positive year and a nice positive year. 2021 was a good year.
Very good.
And so people the pendulum of emotion were swinging heavily to the greed side. I'm greedy. I want more. I want more. I want more. I want more. And then 2022 happened, and the pendulum swung back the other way. When the market's going down, I'm afraid. They wanted to sell. You know, it sounded like
and that's what
the Duke brothers at the end of Trading Places.
Yeah, exactly. Sell. Turn those machines back on.
Love that movie.
Well, that's exactly what happened. You described it exactly the way it was. Now, the rational investor would have been doing the opposite of what those people were doing.
Or at least considering doing the opposite and looking at their strategy, their plan. And let's take a step back. What is the purpose of doing a bucket strategy when you're doing retirement income and things, or trying to create some stream of income? The purpose is to be able to identify and control ourselves around something that we have no control over.
Mm-hmm.
The thing that we do not have any control over is the movement of the market.
Correct.
Nothing we do can control what's going to happen going up or going down, recovery, downturn. So we do buckets to protect ourselves. The beginning stages of it is to protect ourselves, to protect our stable income from the ups and downs of the market. We do it to protect the negative volatility that at some point is happening in the market? When are we going to have another 20%, 15% or more downturn in the market? I don't know. Are we going to have another 20% downturn? Sure, at some point. Don't know when. But I'm protecting, by using a bucket strategy, I am protecting against that negative volatility. Now, on the other side, the market isn't always negative. There is volatility that actually helps us. Significant positive volatility where the market's up a lot more than expected. And right now, we're seeing the S&P and other areas, they're up more than expected, especially year to date. Oh my gosh, they're somewhat on fire, but at least they have been.
Mm-hmm. Yeah.
So we get a lot of questions. Is now a good time? Well, is now a good time to do what? Buy? I don't know. Sell? I don't know. Let's take a look at your strategy. Let's take a look at what's happening in your world. And when we do a bucket strategy, we're identifying, and one of the key factors of a bucket strategy is we've identified by allocating enough money in bucket number one, the low volatility, stable cash, being able to create cash flow for the next 6-7 years. We've identified how much money you need in bucket number one. We've identified how much money you need in bucket number two to be able to replenish bucket number 1 7 years from now. And then that bucket will last for another. So what bucket number 3 is we have identified how much money you can afford to put at risk in the stock market.
At risk, though, I mean, risk is relative here. I mean,
at risk of the value of it going down tomorrow, going down next year. The risk over the next 15 years is mostly mitigated by time. So we don't have the significant risk because of that time horizon. But when we're watching the markets and when we want to spend the money, that's risky. So we don't want to have it anywhere near. We never want to be put in a position where we're spending an asset,
that's it.
Selling an asset that is down in value.
The risk is not that the value could go down. The risk is that the value could go down
and
when
I need to spend that cash.
The money. That's where the risk. Without needing the money, there's really no risk.
But when we do bucket number one, we are making an assumption on what you can earn on bucket number one. In today's world, you could probably get 4 to 5% over that, pretty much, guaranteed by some outside source.
Still sounds really good. Really.
Compared to 3-4 years ago, that's
compared to 15 years ago.
Bucket number 2, we expect 5 or 6%, and we're trying to use these expectations to make sure that we can meet the goals. Bucket number 3 has an expected rate of return, not every week, not every day, not every year, but over time. And so what we've done is we put a barometer on expectation. We know what to expect out of bucket number 1, bucket 2, bucket 3. So
whether that happens or not,
right,
there's no guarantee of that. But that's an expectation.
Based on those expectations, this strategy.
Give me an example. Give me an example. And this, by the way, is what value averaging is. We're going to get to tell you what that is in just a second because you need this setup. But
right, bucket number 1, right now, like I said before, you can get 4 to 5%. You can lock in. You can ladder bonds, ladder fixed annuities, laddered assets that somebody's providing a guarantee and a guaranteed return on.
So you'll probably you're fairly confident you're going to achieve that.
And even there with that though, I still use in planning process like a 2% rate of return.
You mean overall rate
for bucket number 1? For bucket number instead, sometimes I'll use 0 just because I'd rather them have more money than not enough.
Okay,
and so overachieving, what is it? Promise silver, deliver gold.
Okay.
All right. Bucket number 2, I expect in my little mind that bucket number 2 should be at 6-7% or so over a 7-year period of time. In the planning process, I use 4 or 5. So again, I'm trying to underestimate the expectation.
You're expecting maybe 6, but
I want the plan to work with not achieving that. I want the plan to be able to work with less than expected return, not 0, obviously. Now, we can do it at 0, but if you have enough money, but
no.
And then bucket number 3, the long-term stock market, the historical averages are 9.5%, maybe 10%, depending upon different specific time horizons. We figure 9 to 10%. In the planning process, I'm going to undercut that, maybe use 7 or 8. But what that does is it gives me the ability to now
per year.
Now, in any given year, it probably will not be. It probably, over the next 15, you'll probably not see a 7 in there at all.
You might see here's what you may typically see. up 9, up 11, down 8.
Well, what we saw
Down
in 2020 was up 20.
Yeah.
2021 was up 29%. 2022 was down, 18% at one point, 19% at one point. 2023 was up. And so far it's all over the map, which is the way the market always has been. This is not new. The reasoning of what's pushing it up and down, it may be different, but it's always all over. But we're looking at an expectation. And what it does, though, is it gives us an idea. It gives us the roadmap of where do we expect to be 1 year, 2 years, 5 years, 6 years, 7 years down the line.
A benchmark in many ways, right? It allows you to determine whether you're happy with the results of bucket 1, happy with the results of bucket 2 that year, and happy with the results of bucket 3 that year.
But by knowing what to expect, when we get questions where we start to feel euphoric about the market doing great. Yay, what's going on with the market? Should we buy? Should we sell? What should we do? Let's look at your plan. Where are you in your progress towards your goals? I mentioned earlier, we didn't do a lot of value averaging in 2022 because we were under expected returns. Not that it was a problem. The cash flow was still there coming out of bucket number 1. Everything was working as planned, but we were not looking to sell anything in bucket number 3, the long-term growth bucket, because we didn't get the 7, 8, 9% expected rated return out of bucket number 3 in that calendar year because it went down. But as I mentioned earlier, we were talking to clients about value averaging in 2021.
Let's explain. Now, I need you to explain what value averaging is. I know we're like 10 minutes into this podcast, but
and we're getting to the topic finally.
Let's give folks now who don't know what it is. Tell me exactly what it is for people who don't know.
So by doing the buckets, the idea of doing buckets is to protect against the negative volatility the market has, which we have no control over. By looking at how do we take advantage of the other side of that volatility, we're protecting against negative volatility, but there's also positive volatility where it's done better than expected. How do we identify when the market has done better than expected, and how do we treat it? What do we do to take advantage of that positive?
You do what's called value averaging.
We do what's called value averaging.
If we got a 23% rate of return over a particular year, let's say a calendar year.
Yeah.
And I got a 20, and that's what the markets did. Or let's say my bucket 3, my value of my bucket 3.
And we're looking at your bucket number 3 for this.
So we're going to say, well, look at that. My bucket 3 did really well this year. I expected it to maybe get, my benchmark was like 8, 7, 8.
Yeah.
And I got 20.
Right.
So this is where you use this value numbers, averaging strategy.
I started with $100,000 in bucket number 1. I expected after a year to be at 107, 108, maybe 109,000.
There's your 7, 8, 9% expect. Yeah.
I'm at 123,000
in this hypothetical example
because it earned 23% that year. What do I do with that extra, that excess return? Do I stay all in and let it ride? And if it's the first year of the strategy, I got 14 more years for it to go. So am I that worried about it dropping? Some people are. Let's not be greedy and take some of that off the top and refill what I took out of bucket number 1.
So in other words, you have 123,000 in this example. You expected to have 108, call it. So you can take the extra $15,000 off the table. You're actually tweaking your bucket 3 a little bit here.
I'm going back to what I expected to have. This goes back to
and what do you do with that?
Fear. There's a couple things I can do with it. First off, I can go spend it, but that's usually not what to do. I can refill bucket number 1, or I can bump up bucket number 1 and bucket number 2. Or I can set it off to the side, not even consider it part of my buckets as what they call maybe dry powder. So that if or when, because it's going to happen at some point, we just don't know when the market goes down, now I can buy in.
You can refill and get back to where you should be.
I can buy in and push, my return in that long-term growth bucket. So the idea is to identify when you're doing well, better than expected, and take your profits. And then you identify when you're not doing as well. And if you've got the dry powder, maybe you try to buy in a little bit. Well, that's a harder one to do.
Well, it is. And I'm going to ask you this question, because if you took that extra 15,000 that you said, I expected to be at 108,000 and I'm at 123. I took 15,000 out of bucket 3. I pretty much sold those equities, right? Let's just say that's what you did. I got 15,000 of cash. from the sale of that here at the end of the year. And let's say I put it in bucket 1 because I wanted to buy another
year.
year.
I mean, basically looking at math backwards, if I had 100,000 in bucket number 3, I probably started with roughly 300,000, which means I'm probably taking a 4% withdrawal, which means I'm taking about 12,000 out of bucket number 1 each year. So by taking 15 out, I've just replenished and reset my time horizon.
So I've bought myself another year.
Maybe a little more.
Okay, but now...
But I've reset bucket number 1 time horizon. I've reset bucket number 2's time horizon. I've reset bucket number 3's time horizon back to the original plan.
Now, so what if the next year you're 100, now you're at 108, now you expect it to be at 116
6 or something like that.
But we had a bad year. And,
Okay.
And now I'm at 103.
Okay.
Or I'm back to 100.
Okay. That's fine.
I'm
you are
16,000 short. Do I need to replace somewhere?
Do you need to replace? No, you still have 14 years for that bucket to run.
In this example.
Do you want to? Yeah, that's up to you. That's why value averaging is not an automatic, systematic, computer-generated idea. It is something to discuss with you because a lot of other factors go into this as well. Did you spend everything out of bucket number 1 that you thought you were going to spend in that year or over the time period we're looking at? Did you spend more? You went into this with the expectation of spending $1,000 a month from your portfolio, but you were spending $1,500. So that means we need to do some shuffling anyway. Or you went into this expecting you were going to spend $1,000 a month and you only spent $500. Well, that gives us different parameters. What has been happening in your life? Not only what's happening in the market, but how do we need to reshuffle, if anything, your buckets to meet your ongoing, ever-changing needs?
Well, you're spending. Do you ever go from bucket 1 to 3? I can't imagine you do.
Well, it depends. Yes, if you've figured out that you've overfunded bucket number 1, you're not spending as much money, and the market's down, and you say, I only need X amount of dollars in bucket number 1 to meet my spending needs, and I allocated more than that a year or 2 or 3 ago because I thought I was going to need more, and I want to grow my legacy for the kids. Sure, I can then move over to bucket 3.
How hard is that for people to do? First of all, your first year you were made 23%. Your bucket 3 is kind of going gangbusters over this period of time. It looks good.
Yeah.
How do you convince somebody? I mean, is it hard for somebody to say, well, we're going to take some of this out of the stock market here, and we're going to put it into something safe? And they say, well, wait a minute, though. Look, stocks are going crazy. Maybe I could double it.
Well, it's easy to talk about doing it after 1 year, but typically the markets haven't moved far enough in 1 year to put you in a position where you feel comfortable taking money off the top. You're usually looking at value averaging, not every year. Now, we had a couple of years where it was 20 plus, 20 plus, 20 plus every year for a couple of years. Then it made sense to do it. 19, 20, 21, it was pretty good years. And that was meant, now we're significantly above where we expected to be. But 1 year, I mean, the difference between 108 and 112, 114,000, is that enough to make somebody, in our original hypothetical example, make somebody say, yeah, I want to take that $4,000 off the top? No, it's a matter of what's going on in life and how you feel it. But as we get closer, as we get further out, as our time horizon, we set up an original 15-year time horizon. But as we get out to 10 years, 11 years, it's much more likely that you're going to be value averaging 5, 6, 7, 8 years out than waiting all the way to year 15. You probably don't want to wait till year 15. You probably could, but you don't. Just from a risk emotional standpoint, you want to look and take advantage of the market when it's available. Is it every year? Probably not every year, but it is a discussion to have every year based on who the person is, because some people, it's like somebody at the blackjack table, they win one, they're putting it back in their pocket. They are not letting anything get away.
That's me. Well,
and other people are all in until it's over.
But you may have a down year in the stock market, and you would ask somebody, hey, you know what? You've got some safe money here, more than you expected to have. Why don't you take it out of safety and put it into stocks? And they might say, what, are you nuts? Market's down.
I've not had anybody say, are you nuts? Not from that reason, at least.
No, but you know what I'm saying. This is human behavior, though. This is the irrational behavior.
What I hear is, I see what you're talking about. I can understand how that could be beneficial. But no, I'm not I'm not parting with my
Because
cold hard cash.
I'm afraid that the markets
I
are going to
think it's gonna
continue
go
to
down
go down.
further.
Yeah,
Well,
and that's the herd mentality, which happens.
Which is fine.
I am not being critical of anybody who says that. I mean, in the abstract, it is not a good thing. But
And given the two options, the market's up, let's take some money off the table. The market's down, let's take some hard cash and put it into the market. The first one is much easier for a retiree to do. They can see wow, we're up a lot more than expected. Let's scrape some of that cream off the top and let's not be greedy.
Yeah.
But on the other side, it's tough to buy into a down market.
We had a lot of good years between roughly 2010, 11, something like that, and call it 20. Let's say that 2000.
Well, starting in March of 2009.
Yeah, so I'll put it a little forward. Let's say 2009 to about 2021, something like that. We had 11, 12 really good years. And if somebody had set up a bucket strategy back in 2009, 10, right at the bottom, and they didn't do anything, they let their bucket 3, they just let it go,
they'll be fine.
They'll be fine. But I would think that by 2020, 2021, their bucket 3 would be far larger than expected.
But before that, it would have been larger than expected.
And to me, it's kind of like having a plant where you get more rain and growth than you expected, and the plant has just completely
taken off.
Yeah,
I mean, like the weeds in my yard.
Right. Now it's a little different. It's easier to cut back a plant than it is to cut back your gangbusters bucket 3 portfolio.
But you talked about 10, 12 years, really good years. There were some so-so years, 2018 being a so-so year. It wasn't a great year.
Had a bad time at the end.
You should have been looking at these opportunities before you get to the downturn. Now, the problem with that is we go back to that greed and fear thing. I don't want to sell my winners or the market, whatever my stock, because I don't want to miss out on next year's growth. We're not asking you to miss out on next year's growth on all of your bucket number 3. Just miss out on that risk on the extra money that you didn't think you were going to have. Let's pull some money off the table. Let's keep the house's money.
There it is. It's the house money, right? Let's take some of that, put it in your pocket, or
let's make yourself my money, or not your money.
Buy yourself a little bit more time,
right?
And that's the whole idea of value averaging. It's simply, Professor Plum, it's simply expecting a certain amount of growth, let's say, during any given year for bucket 1, bucket 2, bucket 3. And looking at it after a year and saying, where am I? Am I behind where I expected to be, or am I ahead? And if I'm only a little ahead or a little behind, I'm not that concerned. Yeah. If I'm way ahead,
then it's something to really take a look at. And you mentioned earlier, or I mentioned earlier, is now a good time to buy in, to sell off, whatever the case. How are things working in your strategy? How are things? If you've never had a strategy, the best time to do a strategy is when you have the money to do it. Don't wait for it to crash next week if it's going to. Don't wait for it to go, don't expect it to double next week. Those things probably won't happen. But set your buckets up and then monitor your buckets and make sure they're doing it. And not just the performance that we're talking about, I mentioned, but what's happening with you in your life. Reset. This is a living strategy. It needs to reflect the changes that have happened in the market. And you're identifying what's there so you know what to do so that you're not being emotional about those changes. But also, it needs to be able to move with what's happening in your life. This strategy has to be adjusted over time based on you and what's happening to you. So we get the question now, is now a good time? Where are you on your journey? Where are you compared to where you expected to be right now? Do I need to, hit the pedal and really push for more growth so that I can get where I want to go because I took too much time to get from point A to point B, and I need to make up time between now and point C? Or did I get favorable wins and I got to point B well ahead of schedule, and I can lollygag around for a little while until I get to point C? I don't have to push it hard.
The flexibility is the other component that you just talked about, that not present in a lot of other strategies that I've seen.
Well, the flexibility I've seen in other strategies, and they'll go on the 4%.
You have to be flexible because you don't have enough,
You have to change your spending habits because the market's down, and you need to either stop spending until it recovers or spend less so that you stay true to your 4% rule. That's BS.
What an awful thing to have to do.
I don't want the market, which is not my friend, to tell me what I can and cannot do throughout my retirement.
What I would like to be able to do is say, gosh, we spent this much in the last year. I loved doing something. We found a new love, and I'm gonna need another 20 grand a year,
whatever the number is,
because we've found something that we're really enjoying,
and we want to do it while we can.
And we want to do it because I can't do this when I'm 80.
Yeah.
I found a hobby.
Or
whatever.
I might not be able to do it when I'm 80.
I found a hobby, whatever it is, and I want to do this now. This is what so you say
it's 2022. The market's down 18%. You have to cut your spending.
So you can't do that. I know you really found an activity you loved,
but you're not going to be able to because the market wasn't your friend lately.
What a horrible thing to have to. What do you tell somebody? So how do you work that out then, Professor Plum? How do you work that out for somebody with a bucket strategy, let's say?
You're accounted for the next 10, 15 years.
There you go. I need
matter.
more, but I need more. My bucket one is supposed to give me X amount, but
if you've gone from saying, well, I've got $1 million and I'm going to take that proverbial 40,000 a year out, and then you come back and say, I got a new hobby. I need 60,000 a year, 70,000 a year. Okay, well, there's a give and take here. You can do it for a little while, but you can't do it forever. How are we going to make this work? Because
you at least can look at it.
If you make your goal unreasonable, then it's unreasonable. There's some things you can't adjust to.
Well, you can't, but that has nothing to do with what the market's doing.
That's not
Professor,
the market.
That's not the market.
That's not the market.
That's just the total amount of money you have.
We're talking about somebody who has set up their thing saying, I want to spend that $40,000. But the market crashes the next year. You set up your bucket plan in 2020, 2021, and you're setting it up to do your 40,000, whatever the number is, and it's a viable plan. And then the market goes through 2022. Doesn't matter. Doesn't have an effect on you because you have time for those assets that have the value, the decrease in value to recover before you sell them. It's a loss on paper, but it's not a real loss until you sell it. And you have time for that to recover. Whether you're doing this in 2007, before the 7-8 downturn, depending upon how crazy you were in 1999, it still worked.
We've seen this over many different historical
There have
periods.
been a few downturns in the last couple decades. Some of them fairly severe.
And there will continue to be for reasons that we cannot possibly predict.
And even the reasons that we could predict, I mean, realistically, we were predicting the dot-com bubble. We were predicting it way too early, and it kept running, and then we started to have self-doubt, but then it happened. We predicted the great financial reset with the mortgages. I mean, the way they were lending money, everybody knew that was unsustainable, but the market was on fire, so everybody wanted in, and the real estate market was on fire, so everybody wanted into that too. And
I tend to think that when you're in the middle of those things, people think this is never going to end. This party's going to go on.
Well, no, that's why
forever.
It was going the way it was. But rational people are going, I need to figure out a way to take advantage of this, but not risk my life on this.
Well, and that's why you have a strategy, and that's why you do what you have to do. I mean, if I want to increase my my withdrawal rate from 4% to 6%, as you said, okay, we can try it, but what are we going to...
You're going to have to become more aggressive, or you're going to have to accept that you're going to leave a less of a legacy, or that when you're 100 years old, you may not have anything left.
Well, and that's everybody's call. I guess the point with value averaging, Professor Plum, is to wrap this up here, is that it allows your plan to be flexible, to either buy more time or, extend it out a little bit longer, or have something ready to go to take advantage of opportunities.
The way I see it is that you are setting expectations, and you're basically shuffling greed and fear aside. You're making decisions today where there is no greed or fear about the future, and you're saying, I expect this to happen. If better than this happens, I have a course of action. If less than this happens, I have a course of action. I'm setting that course before my emotions get involved. And because once my emotions get involved, sometimes decision making does not go well.
If you can have a strategy, a plan that keeps you from being fearful and at the same time can keep you from being greedy, I'll make that trade-off.
Uh-huh.
I'll say, look, I mean, I don't want to have the fear. I don't want to be up nights worried that stocks are they going to crash this year and I won't have enough money. So if you can take that off the table, potentially, I'll give up the greed chromosome or whatever. I'll give that up gladly.
Most people that are getting ready to retire or are retired they're in a position where they're saying, look, I am where I'm at. I understand that I'm not going to be a multi-gazillionaire, and I'm okay with that. I don't want to be poverty. I would rather status quo, maybe grow a little bit with inflation.
Mm-hmm.
I'm not expecting to go from, the proverbial $1 million retirement to $10 million, 10 years later. I know I'm not going to have that unless I win the lottery.
I don't want to lose it.
I don't want to lose it down to nothing.
And that's why you do a strategy, folks. The people at Lucia Capital Group, the advisors at Lucia Capital Group, are here to help you out. They've been doing this bucket strategy stuff for over 30 years, and I'm not going to overpromise anything on that. But to me, Professor Plum, to take the guesswork out of it, to take the fear out of it. Let's put it that way. And I don't have to guess. Take the fear out of it and take the greed out of it. It to me is worth all of that.
To take that emotional reaction out of the equation tends to make you a better investor.
Give them a call, 800-644-1150, 800-644-1150. Lucia Capital Group, they're here to help you out. Professor Plum or any of the Lucia Capital Group advisors, this is what they do. It's all about strategy. And if you think it's not, try retiring without one. It may work out great, but it may not. So,
and unfortunately, if it may not, you won't know
until it's too
not.
late. Until it's too late, right. Find us online, too, luciacap.com, luciacap.com. I talked about bucket strategy. I should have mentioned this before. Have you seen the bucket strategy guide?
Once or twice.
I've got it right here. Look at me. I even printed it out. Tailored financial strategy for your retirement. This explains a bucket strategy. And I know we do talk about it a lot, but this is important stuff, especially for people who are retired or they're trying to plan for their future. If you want to know anything about the bucket strategy at all, download this guide. If you want to know everything about the bucket strategy, at least the Lucia Capital Group bucket strategy, download this guide. It's free. You go to luciacap.com, luciacap.com. There's a section up in the right that says search. You can type in bucket strategy, and it should be the first thing that comes up. Download it. It'll take, few seconds, and read it. And if nothing else, if you read up to just page 4, you will at least get an overview of the bucket strategy if you don't know how it works. I would suggest you read further.
You have questions? Send us emails. We'll answer it.
We will do that. So get it. It's the bucket strategy, tailored financial strategy for your retirement. It's the guide at luciacap.com. Find other articles and all that stuff also at luciacap.com. Don't forget, subscribe to this podcast. We get new subscribers every single week. We thank all of you folks, and it's nice to hear from you too. Go to Apple Podcast or Spotify and get those episodes downloaded to your device every single week. Do not miss a single episode. Must I remind you every single week? I feel like I'm doing that. It is important, though. Hey, Professor, thank you so much. I know you got work to do, but this is always fun for me.
Oh, it's a nice break in the day for me, too.
It really is. We just get to talk,
Which we love to do.
We've been doing it for a long time. For Professor Rick Plum, you are, by the way, a certified financial planner professional, CFP, and a... Doggone it. Give me the other designation.
AWMA.
Yeah, but I know it's AWMA. That's accredited? No.
Wealth Management Advisor.
Oh, it is accredited Wealth Management Advisor.
Yeah, but
and
close enough. Advanced accredited, yeah.
You've threatened to get even one more designation, as I'm told.
Yeah.
Well, we won't mention it.
Unless I actually do it.
Right.
It's a great way to do my continuing ed.
Otherwise, we'll just forget about it. For Professor Rick Plum, CFP, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.